Welcome to the Business Talk podcast. I am your host Deepak from India. We are honored to welcome Dr. Tirthankar Roy, Professor of Economic History at the London School of Economics and Political Science, as our distinguished guest on Business Talk today. Professor Roy teaches South Asian and Global History at the London School of Economics and Political Science, UK. He is the author of Monsoon Economies, India's History in a Changing Climate, along with several other influential books and articles. His research in economic history addresses three central questions. First, is there a long-term pattern in Indian capitalism? Second, can historical insights help us better understand the working of modern Indian capitalism? And third, how have climatic conditions influenced long-term economic change? Professor Roy's research interests include the history and development of South Asia, global history, empires, and environmental history. His publications include Law and the Economy in Colonial India, which examines the multiple influences that shape British Indian law and explains why it often failed to serve its users effectively. Its sequel, Law and Economy in Young Democracy, explored the historical roots of modern Indian legal frameworks and the enduring impact of colonial legacies. Forthcoming from Oxford University Press, his latest work, Water and Development, the troubled economic history of the arid tropics, argued that the economic rise of arid and semi-arid tropical societies has hinged on their abilities to manage water and development resources and transform their environments, a politically fraught process that continues to challenge federal democracies. Dr. Roy received his early education at school and university in Santiniketan, India, and earned his PhD in 1989 from the Center for Developmental Studies, India. In today's episode, Professor Tirthankar Roy discusses key insights from his acclaimed book, A Business History of India, Enterprise and the Emergence of Capitalism from 1700. Let's not keep you waiting. Please join me in welcoming Professor Tirthankar Roy to the conversation. Professor Roy, it's a distinct privilege to welcome you back to Business Talk, and what a fitting occasion it is, as we
My
explore
pleasure.
a work that I would truly call a modern historical classic. Having you with
Thank you.
us for a second time is not just an honor for our channel, but a wonderful opportunity for our listeners to go deeper into a conversation that frankly deserves much more than a single sitting. Welcome back, Professor Roy, and thank you so much for having us today.
My pleasure.
Professor Roy, one of the most striking arguments in your book is that capitalism flourished in India despite persistently scarce and expensive capital. How do you explain this paradox and what does it tell us about resilience of Indian entrepreneurship over 300 years?
Yes. Let me start with this statement that capitalism flourished in India, which is absolutely right. For several centuries, you see this region as functioning as a major commercial hub in the world. Its position in the Indian Ocean, right in the middle of major trading zones, trading routes on the eastern and western side of the Indian Ocean, and major empires ruling the north, the Indo-Gangetic Basin, which had connections with Persia, with Central Asia, with Ottoman Empire. All of these combined to create quite strong urban economies and a lot of trade, as well as very high quality artisanal production. So that's the kind of world that we are talking about here, and the transformation of that world. Yes, you are right. I mean, the puzzle is that compared with Europe at the same time, that is the 17th century or 18th century, the cost of capital was higher in India. Possibly it was higher in China as well, which is again a major trading zone. So that's a sort of a global history puzzle, if you like. How does large scale deployment of capital happen where capital is costly? And the book answers it in the following way, which is quite an obvious answer, which is that the cost of capital partly reflects the risks that creditors take in lending to borrowers who are not very well known to them, or whose circumstances are not well known, or who may shortchange them. Now, if you can control that risk, then transactions will happen. And in India's case, possibly globally, in many cases, you will see ties of caste, kinship, family, and other types of social networks were used very actively to bring down these costs of not knowing who your clients are. There were social and cultural ways of making sure that the clients actually are reliable, they repay. A lot of transactions happened within the network between people who are distantly related, or they have other people who can guarantee honesty. So these informal networks have a very large role in making capital investments less risky. The final point I want to make in this connection is that the world we are talking about is really primarily a commercial world. So it's trading capital that is primarily what we are talking about. Now, trading capital circulates. I mean, you invest and you get it back. Um, when you move to large-scale industry, mechanized industry, that's the more modern times. Sorry, that's when the investment problem takes on a new dimension because you are locking up capital for a very long time in a venture which still hasn't started giving you returns yet. Now, and it's much larger scale capital. Now, that's a very different problem of investment. And at that point, you do need capital market, you do need institutions, you do need banks, stock markets, and other types of, and of course, the legal protection offered to joint stock limited liability companies. You do need that framework, and much of that framework India inherited from Britain, but it came very early in the mid 19th century, and that enabled many rich people to move to industry as well.
Professor, your book examines the Mughal Empire, the East India Company, British Crown rule, and independent India through three common lenses: access to capital, integration, and with global trade, and migration of labor. Did you find it surprising that these three themes remained so consistent across such vastly different political and economic eras?
Well, yes, to some extent, that's right. But my general approach to economic history has been that, I mean, most Indians are products of a nation state, and we take states very seriously. We take politics very seriously, and we have been kind of taught to think that politics shapes everything, and it is kind of very omnipotent force. That's not quite the case if you take a long view of history. You see other elements that are also shaping economic change very radically, very deeply. One of them is, of course, geography. The fact that India has an enormous coastline, which has been a commercial hub for a very long time, even for a long time before the Europeans came. The Europeans changed the game somewhat, but they really came because these coastal trading hubs existed. And it was transacting in commodities that they wanted, like textiles or spices. So, I mean, the coastline is one of the geographical advantages. If you move in the interior, you see these very large bureaucratic states like the Mughals ruling over the Indo-Gangetic Basin, which is one of the most fertile, well-watered agricultural zone populated for millennia. So you have cities there which live on agricultural surplus, and once again, that creates demand for very high quality artisanal goods and trade in grain and trade in horses and all sorts of things. So to some extent, the business world is, if not a product of, it's very deeply shaped by geography. And if you look at business history in that way, then of course geography doesn't change that as quickly as politics does. So we begin to see some long-term pattern here.
Professor, you argue that on each occasion of business growth in India, connections with the global economy were decisive in helping firms manage risk. Can you walk us through a specific historical example where global integration proved to be a turning point for Indian enterprise?
Absolutely. I mean, there are several examples, but probably the most striking one is the one in Western India, where you have in the 18th and 19th century, very robust cotton trade and cotton export trade, cotton domestic trade. Cotton is one of the old products from Indian agriculture, which has been commercialized very early, and it's also the reason why India has always had a major presence in cotton textile production. But in the 18th and 19th century, a lot of cotton was going to not so much to Europe, first to China, but later to Europe, and also trading domestically. Now, the people who made money in this trade, like the Gujaratis, the Parsis, the Bhatiyas, and quite a few other communities. I mean, they were quite significant, substantial. Boras as well. Now, in the 19th century, some of these cotton merchants, who are very rich people in Bombay city, they could think that it's a very short step for us to start a cotton mill in Bombay. We know where this cotton is going in England, and where it is going, there are machine makers. They talk to us that, why do you export the cotton? You can keep it in Bombay and start a mill. And some of those same people, the machine makers like Platt Brothers and others, they would send their engineers, their foremen, their people with the machines to Bombay, install the machines. They will live there for a few years, make sure that this setup works. And that's how Bombay became one of the world's leading mill towns, textile mill hubs. Probably the world's fourth largest textile mill complexes emerged in India, in Bombay and Ahmedabad. Later, Kanpur, Coimbatore, and Madras as well. But you cannot really explain this. I mean, much of it is owned by Indian people. And at least at the start, many of these people who were pioneers in cotton mills were cotton merchants selling goods to places where there were people who could advise them about how to start a mill. So that connection is very close, but you see that connection in many other cases as well.
Professor, the managing agency, an Indo-British partnership that managed multiple, often unrelated companies, was the dominant business structure in colonial India. How was this model an adaptation to scare capital and managerial talent? And do you see echoes of it in today's Indian family conglomerates?
To some extent, yes. I mean, that's a very interesting question. I mean, we have to understand what managing agency was doing. I mean, it's not not exactly a business model or organizational model that came from Britain. It emerged in South Asia, Southeast Asia, among first European businesses, actually originally in insurance, and then it moved to corporate management, broadly speaking. Um, it's a very interesting concept where one company, which is typically a partnership company, a partnership firm, is given the management contract of a publicly held, maybe textile mill or jute mill or a coal mine. The management contract is sometimes very long lasting, maybe 40 years, 50 years. So effectively, the managing company, the partnership firm, which is called the managing agent, is basically a kind of owner or the board of director for the company. But having a company helps because, as I said before, a corporate can go to the market, capital market, and raise money. That's the cheapest kind of money you can get from what you get from the stock market. And that cotton mill company is able to raise this sell shares and raise money, which is very cheap without liability, but it is doing it on the reputation of the managing agent. So people who are buying those shares, they see that it's being managed by maybe Tata Sons or Birla Brothers, and it must be good. So that's part of it. I mean, as you said, in the eyes of the shareholders, the managing agent represents good management that has been tested in other companies, and reliability. Now, the problem for the owner is that, I mean, typically a managing agent will have a minority shareholding in the company as well, maybe 5%, 10%. But the problem for that kind of ownership is that it then exposes the company to takeover risk. And anybody can buy shares and take over the company. And to avoid that, the managing agency becomes a kind of second line of defense. That management contract is so long that you can take over the company, but you will still not be able to run it. Um, so in effect, it is yes, as you said. I mean, it's conserving on capital, reputation, management, and also it is from the owner's point of view, it's avoiding the takeover risk. So it became a very handy instrument in a stock market which is still very in the very early stages of development. I mean, many owners don't really know who the operators are, and it was never completely trustworthy instrument for many people, trustworthy institution for many people. There are a lot of insider trading and insider exchange of information. So managing agency became a kind of line of defense that the real entrepreneur will be able to run the company without any worries. It's a very peculiar institution in places where the capital market is new, relatively undeveloped, and still a lot of corporate investment is taking place. It had a slightly different change of meaning between Europeans and Indians. I mean, most Indians will have one managing agent and one corporate firm. Europeans had managing agency firms, partnership firms, which managed 20, 30, 40 companies. And usually these companies changed hands often. So the managing agent was much more like a management consultant firm, not quite owners. So when you think of Andrew Yule, it was rather close to being a consultancy firm. Of course, it did actually invest a lot of money, but primarily in terms of its managing agency function, it was more like a pure manager. Um, Coming to the last part of your question, I mean, do we see any legacy of this today? I think, this idea that there are specialist managers whom the owners trust, and you can actually subcontract some of the management to them. That is an extremely widely used concept. It just shows up in different ways. I mean, you don't actually call managing agent, but within a board, within companies, you have subcontracting of tasks all the time. So that has not only been persistent but also growing because a lot of these services are now contracted out. A company doesn't try to do everything in its own premises.
Professor Chetiyar's Marwaris, Parsis, Bohras. Community networks are often credited as the backbone of Indian entrepreneurship. But you argue that weak social ties were sometimes more decisive than strong community bonds, especially in coastal cities. How does that challenge the conventional narrative?
Yes, well, that's an interesting aspect. I mean, as I said in the beginning, community ties do matter in reducing risks, risks of not knowing who you are dealing with. So that is something that where I mean, knowledge and information, access to knowledge and information, especially about people. That's a field where community ties are very handy. It's a very positive resource. But community ties are also very problematical for many reasons. I mean, first, communities are not necessarily democratic institutions. And within family, caste, networks, communities, you often have um, very difficult relationship between older generation and newer generation who want to do different things. So it's not necessarily a very pro-business institution. It has weaknesses. It has problems. We need to. I mean, if you for example, study the number of disputes within business families. I mean, you see how disputatious this organization is. People actually challenge the authority of community all the time. So that is part of being a little cautious about how we treat these communities. But the other part is what you say, the weak ties. The weak ties concept comes from economic sociology, especially Mark Granovetter's work. I mean, it points to the concept that a strong bond like a community will serve certain purposes, but it can also discourage innovations by not letting new ideas come in. It's basically a way of command and control system, which functions very efficiently, but it's not necessarily very innovation friendly system. But innovation friendly environment needs a lot of people who are not necessarily bound by ties of family and kinship, but but they do socialize and they bring in different types of skills and knowledge sets within that society. So that's the weak ties concept. And I mean, you see that in several examples of this. And probably one very interesting example is the very offbeat decision taken by Jamshedji Tata to start a steel integrated steel plant. Now, this is offbeat in the sense that in the late 19th century, when he had this idea, I mean, of course, he had a mill in cotton mill in Nagpur, and I mean, while operating it, you could see that practically everything that you need for an integrated steel factory, limestone, coal, or manganese and iron ore, are available in central India, eastern India, but not very well connected way. I mean, they're often available in very remote places. But if you can connect them up, you can create this factory. So, oh, sorry. But to make that idea work, he had to collaborate with people like mining engineers, like prospectors, American steel consultants, who had nothing to do with the traditional way of doing business in India at the time, which is a very textile-oriented business world. Parsis relying on other Parsis, Marwaris relying on other Marwaris to do business. I mean, he knew that for a steel factory, he couldn't do that. I mean, he will have to induct people who are Americans or Bengalis and other types of people who are not from the business world, but they understand certain aspects of technology and mining and prospecting and transport. And it's a diverse skills that you have to bring together to make a steel factory happen. So that's a very good example of how a port city, which could actually attract this diversity of skills, could generate this idea that let me start a steel factory, which is an enormously ambitious and expensive enterprise.
Professor Roy, your book takes a somewhat controversial position that integration with the British Empire through free trade, contract law, railways, and steamships actually based constraint on Indian capitalism that predated colonialism. How do you respond to those who argue that colonialism was fundamentally extractive and damaging to Indian business?
Well, I mean, as a economic historian, as a business historian of trade, there are two things here. I mean, one thing is that the word extraction doesn't really have any clear meaning for me. People, I mean, what we often refer to, or what other people will refer to as extraction, is somebody, a foreigner coming to trade, making money, and then repatriating that profit. I mean, that happens everywhere. I mean, it's not, if it happens today, we won't call it extraction. We'll just call it remittance. Um, so, I mean, it's not as if extraction meaning a certain type of payment, which cannot happen without political dependency. It's a very hard to measure and hard to prove concept. Um, so this broad characterization that colonialism is extractive, I don't know how to test that assertion. So I mean, I'm not saying that it doesn't work, but I don't know how it works. But the second thing that I have learned as a business and economic historian is that most private enterprise requires collaboration and partnership, and it's not a case of Europeans versus Indians. Almost every foreign enterprise that you see happen in India, and India was one of the world's emerging economies in the 19th century. So a lot of industry and trade happened here with foreign capital. Every case, you will see that there are stakeholders, a large number of stakeholders who are Indians and who are involved in that enterprise. So think of, for example, commodity export trade. I mean, India exported a lot of wheat and cotton. So when you observe that trade in the port city, you will see this. There are many old photographs which show hundreds and thousands of cotton ready for export. I mean, the cotton bales basically waiting for a ship on the port. I mean, the enormous scale of that business is just amazing. Um, when you observe the port, you will see operators who are some are Indians, but many are Europeans. Big players like Volcard or Raleigh and others, they're doing commodity trade. And they're doing it, they're in that game because they know the final market quite well. However, the same cotton, when you see the other end, where are they coming from? From Ahmednagar or from Khandesh or from Gujarat? You don't find Europeans there. The people who are running the ginning business or people who are actually dealing with the farmers are all Indians. And Europeans cannot really do that business because it's very high risk there. I mean, most of these people, they don't know enough. So without these two types of stakeholders, you won't have the cotton export trade. And you can again find many examples of this. I mean, in Calcutta's jute textile business, which was almost entirely European owned, the raw jute market was was operated by Marwaris and Bengalis. So it's not as if you take away. It's not as if these two interests were um, working against each other. So if you generalize that, I'm not saying that Europeans and Indians were always friendly, but you do have areas of competition. But because of colonial rule, necessarily you do not have an antagonistic relationship. That's not the framework with which we can understand business.
Professor, you write that productivity in manufacturing and trade continued to rise after World War I, even as agricultural production stagnated. This challenges the popular deindustrialization thesis. What does the data actually show about the divergence between these two sectors during the colonial period?
Yes, well, we have very good data for for the first half of the 20th century. If you try to estimate these data for a little before that, there are really serious problems of measurement. But they will probably tell the same story that um, trade, transportation, industry, finance were doing very well, both overall as well as per head, which means that people could, in a generation or two generations, could actually hope to expect to make money, serious money, by doing that kind of thing. We have to realize that that it was largely a private sector economy. The government was a very small sector, so maybe 5% of GDP. The rest was entirely private enterprise, of which, if you take a date like 1900, possibly 65% is coming from of income is coming from land, and the rest is from other types of activities. Now, these activities which deploy private capital, and you can call them capitalist if you like, as opposed to agriculture, which deploys land. I mean, that's private asset, of course, but it's not liquid capital. Um, these private activities experienced growth and productivity growth. Agriculture didn't. I mean, that's where your question is coming from. If you go beyond what was it that was driving the private enterprise productivity growth, you basically see um, possibly at least three, maybe four factors. One of them is that one of them is, of course, the industrialization, the growth of corporate industries, and they had much higher labor productivity, and any expansion in that sector will drive productivity. The second one is railways. The railways contributed to productivity indirectly by, of course, saving on transport costs. But also the railway system was itself becoming much more productive. That is, it was carrying more goods by weight per head over time. That is, it didn't it was an enormous employer, but it didn't need to expand employment to the same extent as as its operations. So it was becoming more efficient. The third very surprising source, and that's where deindustrialization comes in, is that the many types of artisanal industries also experience productivity growth. Now, we don't know whether that's a early 20th century thing or when it started, when it when it really took off. But it's a very surprising result because we normally think that crafts were under distress because of competition from mechanized industry. They were not. I mean, at least some sections among them were not. And finally, the fourth one is productivity in trading, commerce. Now, that is the hardest measurement problem because trading incomes, net incomes, are very hard to measure. Most of these people, the commercial actors, don't pay taxes, and we don't really know. I mean, just from looking at how much goods were traded or what their value is, you cannot really estimate how the companies are making money. But from several indirect indices, we can assume that trading also was becoming more productive per capita. Now, that's one side of the story. If you go back to this general points about capitalism and business environment, all of this was a positive, made a positive contribution to private capitalist investments. Um, the question then opens up, then why did agriculture not respond? Hmm. And my understanding here is that agriculture didn't respond because although agriculture was exporting a lot of goods, and they were making money for merchants, but farmers didn't get better off because their main asset, land, was very much conditioned by geographical features, climate, soil, weather, seasons, and you could have a very robust capitalist system working. That doesn't necessarily translate into land productivity. That requires a very different kind of policies, and it's really only during the Green Revolution that you had a land-focused productivity policy start to deliver.
Professor, after independence, the Indian state monopolized heavy engineering, oil, banking, and telecommunications through public corporations. In your view, how did this policy environment shape and in many ways suppress the private entrepreneurial energy that had been building for centuries?
Well, there are several things that happened. I mean, I don't want to sound too negative because there were, of course, some positive side to what happened after 1947, but it was a very high cost development policy which focused on industrialization in heavy industries, that is, metals, machines, chemicals, which are very capital intensive, very import intensive because the technology came from elsewhere, and therefore foreign exchange intensive. And none of these were easily available resources. So the government really started controlling the finance and foreign exchange distribution. And that, going back to your question, I mean, that had a very negative impact on private enterprise. And the private enterprise that did suffer were the old style textile plantation complexes, which had been exporting a lot before. They couldn't modernize. In the 1970s, you had extensive industrial sickness in the textile and engineering industry because of that. So the government basically starved them of technology and capital, allowing many of them to die. So that was, and with enormous cost in terms of unemployment, urban unemployment. So the 1970s and 80s were a very bad time in India because of this. So that was one of the costs of the industrialization policy. However, you do observe that a small section of business families did benefit from this. They were able to get licenses and they could join this diversification program quite successfully and move into metals, machines, chemicals, and they diversified away from textiles and became quite wealthy. So you have both sides of this, but the one side of decline and another side of making use of new opportunities. Um, the decline story also had many types of foreign businesses who, especially in textiles and plantations, and commodity trade, who had to leave India. And there is always a question in my mind whether that was really necessary. I mean, 30 years later, India is still, asking foreigners, come invest here. 1950, they say, no, no, don't invest here. We don't want you. These two things don't go together. And it just, my sense is that it was just crazily wrong policy, politics at the time. The other cost was macroeconomic. I mean, this policy of diversification was very foreign exchange intensive, but it didn't actually produce exportable capacity. What it did was it destroyed exportable capacity in the more traditional sectors which were earning foreign exchange, like textiles and tea and other and commodity trade. Commodity trade was almost completely nationalized. Um, so when you have this combination, and this combination didn't appear only in India, it appeared in country after country, which were trying to do something, move along a very speedy and industrialization path, that they were spending a lot of foreign exchange earned through foreign aid primarily, but they were not creating the capacity to repay this foreign exchange. So what you then have, if you persist with that, is balance of payments crisis, and that hit a large number of developing countries in the 1980s very badly, and it hit India probably not in a very serious crisis way, but it was a persistent problem. And throughout the 60s, 70s, India's response to that problem was to tighten up even more. Um, not really open up the economy, but tighten up even more or build ties with the Soviet Union on barter trade. But none of these options were sustainable. And by the 1980s, political administrators could see that um, it's probably safe to to liberalize the economy because foreign exchange were coming in from remittances at the time. Labor remittances, especially from the Gulf, was becoming a very big inflow. And that kind of changed the equation quite significantly. And I believe that that was the turning point when politicians could actually take some risks and open up the economy. And almost immediately, you had a massive upsurge of exports of garments, gems and jewelry, leather industry. That's the 1990s export boom, which then transformed into the services export boom.
Professor, the liberalization of the 90s is often seen as a rupture, a fresh start. But your book suggests it was more of a restoration, a reconnection with much older pattern of globally integrated capitalism. How does history reframe our understanding of the 90s reforms actually meant for India?
Yes, that's an interesting question. I think there are two. I mean, this idea of going back to a past pattern of economic change. I mean that's a kind of slightly rhetorical. Of course, we are not turning the clock back, but in two senses, I think you can see some sense in this statement. I mean, one is, of course, as you said. I mean, India is the liberalization really signifies that India is kind of changing its relationship with globalization. It was a very hostile relationship for about 2 or 3 decades after independence. We don't want foreign investment. We don't want to rely on foreign trade. That changed. So we now know that these are not sustainable and they don't make much sense. So bring the world back in. That is one sense in which I think you can see a broad similarity between 19th century and today. The other sense in which you see a similarity is the ability to use one's comparative advantage, resource advantage, much more effectively. Um, but where these advantages lie, that has changed. In the 19th century, it would be maybe wheat export or cotton export. I mean, that's not what we do today. We export software, we export machine tools and stuff like that. But software is very service intensive, and it implies a reliance on an abundant resource in a very similar way that 19th century economy, private sector economy, relied on abundant resources that were relatively abundant in India. So in that sense, again, I think we are the present pattern of economic change is very much more market-driven, more capitalistic in the sense in which 19th century change was.
Professor, I would like to conclude this episode with one last question. You describe India as having developed a distinctive regional capitalism. After 3 centuries of case studies, firms, commodities, entrepreneurs, how would you summarize what makes Indian capitalism uniquely Indian? And what lessons does that hold for the India of today?
Um, well, one can only speculate here, but there are, we compare emerging economies all the time, and if you have a basket of countries there, Russia, China, South Africa, Turkey, India. No country is similar, quite similar to the others. I mean, they each bring in to this process of rapid transformation something very distinct. And I think in from a present day perspective, what you see very distinct about India is the enormous success in service exports and labor exports. It tried to industrialize, but it's actually China industrialized a lot more, so India didn't. Um, so no matter the ambition, India didn't actually become a manufacturing powerhouse. Um, However, it did become a service export powerhouse, and its labor export to the outside world has been a major driver of economic change in many ways. And I think that is a very distinctive thing about India, and that is, if you take a long view, you see that sort of enterprise. I mean, India was in the 19th century, it exported millions of people to work in other colonies of the empire, and many of these created permanent settlements. Um, so from Hong Kong to Singapore to East Africa to Caribbean to Pacific, everywhere you see Indian people working. So it's not something that is totally offbeat. It's not new. In the 1970s, you had massive export of people to the Gulf, Persian Gulf. But once again, I mean, that had a prehistory. I mean, India's the relationship between Kerala coast and West Asia is a very long-standing one through trade, through people exchange. So I think, I mean, in one word, the answer to the question is people and mobility of people. That's very distinctively Indian.
Professor Roy, your book is a landmark contribution, not just to academic scholarship, but to how all of us understand India's economic identity. You have shown us that Indian capitalism is not a recent invention, not a borrowed one. It has roots going back 300 years, shaped by resourcefulness, entrepreneurship, adaptive business structures, and the courage to connect with the world. The story of Indian enterprise is ultimately a story of human ingenuity trumping over constraints. On behalf of Business Talk and our audience, we are deeply grateful for your time, your insights, and for giving us a history that truly matters for India's future. Thank you once again, Professor Roy.
Thank you very much. Thank you very much for hosting me.